Governments everywhere are really staring down this huge problem. Massive, growing mountains of debt. How do you manage it?
Right. Investors are getting nervous. Central banks are, let's say, hesitant to just print endless amounts of money.
Exactly. And policymakers feel trapped. You hear about two main options:
Hmm.
inflate the debt away, or, the big one, default.
Yeah, neither sounds great.
But what if there's a third way? Something governments have actually used quite a bit historically.
Ah, you're talking about financial repression.
That's the one. And in this deep dive, we're going to pull back the curtain on what that actually means, what to expect, because it seems to be unfolding right now.
Mm-hmm.
And really importantly, how you can think about navigating it. We're leaning heavily here on work by financial historian Russell Napier. His insights are, well, absolutely key.
Definitely.
This isn't just some academic exercise. It's happening now, and understanding it is, I think, crucial for you.
Absolutely.
All right, let's unpack this then. Financial repression. What is it at its core?
Well, think of it as a government toolkit, a set of policies designed to make managing public debt easier,
Okay.
but without resorting to those really politically difficult choices you mentioned, things like huge tax hikes, big spending cuts, or just letting inflation run wild.
So more subtle methods.
Exactly. The main tool is usually governments borrowing money at artificially low interest rates,
How low?
often lower than the actual rate of inflation.
Ah, okay. So if inflation is 5%, they might borrow at, say, 2%.
Precisely. And what that means is the real value of the debt, what the government actually owes in terms of purchasing power, shrinks over time.
And the flip side of that coin.
The flip side is that the real value of savings like cash in the bank or maybe even some bonds gets quietly eroded. It's a stealthy way to reduce the debt burden.
So it's not just about low rates, though, is it? I mean, the debt levels are huge. Napier talks about it being more like a whole regime.
Yes, it's much broader than just tweaking interest rates. It involves directing big financial institutions, banks, insurance companies, pension funds, directing them to buy and hold government bonds.
Even if their returns are bad, like below inflation.
Even then, yeah. They become what Napier calls captive markets. Through regulations, maybe incentives, sometimes even direct rules, these institutions are kind of pushed into absorbing government debt.
Wow. Okay, so it's like creating guaranteed buyers for your debt, even if it's not a great deal for them. That sounds, well, quite powerful.
It is. And another piece of the puzzle is often capital controls.
Ah, right. Stopping money from leaving the country.
Essentially, yes. Restrictions, sometimes they're really obvious, but often they're more subtle. Things that just make it harder or less attractive for investors or companies to send money abroad looking for better returns.
Keeps the money trapped domestically.
Exactly. Keeps it available to finance the government's needs.
Capital controls, though. I mean, in today's world, everything's so digital, so global. How would that even work? Is it like putting up walls?
That's a really good point. Outright bans are probably less likely, at least initially. Think more subtle friction.
Like what?
Maybe increased reporting for moving money overseas, or new taxes on foreign investments, even just making the paperwork a nightmare. It doesn't have to be a total block, just enough friction to discourage outflows and keep more capital at home.
Got it. It slows things down, makes it less appealing. And this whole process, this quiet erosion of savings, it reminds me of that metaphor, the boiling pot.
Yeah, that's a good way to think about it.
Financial repression is like that slowly heating pot of water. It warms up so gradually you might barely notice. But the assets inside your savings, maybe your bonds, they're quietly being cooked, losing real value bit by bit without some big, obvious market crash.
It's a slow burn. And we have a really clear historical example. Look, the US and the UK after World War II.
Right, massive war debts.
Huge debts. And they managed to bring them down significantly over the next few decades. Not through default, not really through spectacular growth either.
Now then.
Mostly through financial repression. Interest rates were kept below inflation for years. Savers and pensioners, people holding government bonds, they basically lost purchasing power year after year.
So the debt shrank in real terms.
Exactly. The U.S. debt to GDP ratio went from over 100% in 1946 down to under 25% by the early 1970s. That value was transferred quietly from savers to the government.
But like you said, though, it was a different era, right? A much more closed, heavily regulated financial system.
Yeah.
How does that playbook even apply today with everything so interconnected and, well, digital.
That really brings us to the why now question. Why dust off this old strategy?
Yeah.
The context is pretty clear. Public borrowing just exploded across the developed world after the 2008 crisis, and then again with the pandemic response.
Debts are at historic highs outside of wartime.
Right. And governments are, frankly, desperate for solutions that don't involve immediate political pain. Tax hikes are unpopular. Spending cuts are unpopular.
So, this leads to Napier's main argument, this shift he talks about, from monetary dominance to fiscal dominance. What does that mean exactly?
Okay, so monetary dominance is kind of the world we thought we lived in for the last few decades. Central banks were largely independent, focused on inflation targets, maybe employment. They set the monetary policy.
They were in the driver's seat.
Pretty much. But under fiscal dominance, the government's borrowing needs become so large, so persistent, that they effectively dictate policy. The government budget, the deficits, they hold the real power.
And the central bank?
The central bank is forced to play along. They have to help finance the government, keep borrowing costs manageable, even if it means letting inflation run hotter than they'd like or compromising their independence. The Treasury's needs come first. The tail starts wagging the dog.
Why is this shift happening now? Why is fiscal becoming so dominant?
Well, look at the pressures governments face. Aging populations needing pensions and health care, ongoing demands for social programs, increased defense spending, plus the need to keep economies stimulated.
And cutting spending is just politically toxic.
Extremely difficult. Voters don't like it. So continuous deficit spending becomes almost locked in. And if you can't easily cut spending or raise taxes, how do you finance it?
Financial repression becomes the tool.
It becomes the tool of choice, not because it's the best economic option, but because it's, as Napier puts it, politically survivable. It hides the costs, spreads the pain out slowly, and often invisibly.
Okay, so if this is the likely path, how does Napier see it playing out? What should we actually expect to see?
He anticipates, first, more regulatory pressure on those big institutions we mentioned, pension funds, insurers, banks.
Forcing them to buy more government bonds.
Essentially, yes. Maybe through changing rules about what counts as a safe asset. Europe already classifies government debt as risk-free, encouraging banks to hold it. Japan might be heading towards formalizing this even more. It's what Napier calls the politicization of savings, directing private savings towards state goals.
And capital controls, you mentioned those earlier.
Expect a creeping return of those, too. Again, probably subtle at first. Measures to discourage money from leaving, to keep it trapped domestically so it can absorb government debt. History shows governments get creative when they need to trap capital.
Anything else? What about inflation?
This is a big one. Napier suggests governments might not just tolerate higher inflation, they might quietly target it, perhaps aiming for something sustained in the, say, 4 to 6% range.
Why?
Because moderate sustained inflation is a very effective way to erode the real value of government debt over time. It's a hidden tax on savers.
But that sounds dangerous. Can they really control it? Keep it at 4–6%.
That's the huge risk, and Napier flags this. Trying to fine-tune inflation is like playing with fire. Once inflation expectations become unanchored, it can easily spiral out of control. The cure could become worse than the disease.
Okay, so we have this picture. Low rates, captive buyers, capital controls, maybe higher inflation. Given all that, the crucial question for you, the listener, is who wins and who loses in this kind of environment?
Right. Well, the clearest losers are pretty obvious. Traditional savers. Anyone holding cash or relying on fixed income investments like standard government bonds.
Because inflation eats away their value.
Precisely. If interest rates are deliberately held below inflation, your money is losing purchasing power every single day. Pensioners, people on fixed incomes, they get hit hard. That supposedly risk-free government bond effectively becomes a guaranteed way to lose money in real terms.
What about the institutions, the banks, and pension funds?
Their business models also come under serious pressure. Returns get squeezed. And they're increasingly forced to act almost like agents of the state, prioritizing government financing needs, potentially over maximizing returns for their clients or shareholders.
And passive investors, people just holding index funds.
Napier has a warning there, too, especially for those heavily in large-cap indexes. If financial repression really bites and institutions are forced to sell equities to buy government bonds, the selling pressure could hit the biggest, most liquid stocks hardest. Being purely passive might become a much riskier strategy than people think.
Wow, okay. That sounds pretty bleak for many traditional approaches.
Yeah.
But presumably it's not all bad news. Are there potential winners or areas that might do well?
Yes, there usually are shifts in winners and losers. Historically, hard assets have done well in these periods.
Like gold, real estate.
Exactly. Gold, commodities, maybe productive land, real estate, things that have tangible value and tend to keep pace with or even beat inflation. Gold, for instance, did very well during the last major period of financial repression post-WWII.
What about stocks? You mentioned selling pressure on large caps.
True, but Napier suggests select equities could benefit, specifically companies in sectors that align with government spending priorities.
Such as
Infrastructure, defense, maybe energy security, green transition initiatives, areas likely to receive significant public investment as governments try to stimulate growth or meet policy goals alongside managing their debt.
Okay, so hard assets, specific equity sectors. Now, here's where it gets really interesting, I think. How does all this connect to, well, the new elephant in the room, cryptocurrencies?
Right. Napier's framework was developed looking at history, but it has fascinating implications for crypto. It's like a whole new chapter.
How so?
Well, consider stablecoins first. Things like USDC. They're often backed by short-term government debt, like T-bills.
The very things governments want people to buy.
Exactly. So paradoxically, stablecoins could end up providing the sort of quiet background demand for government debt, potentially helping the system function, even if unintentionally. They could become part of the plumbing that supports this repression regime.
Huh. That's an unexpected twist. Stablecoins helping the state manage its debt.
It's a possibility. But then you have the other side, genuinely decentralized cryptocurrencies, Bitcoin, maybe Ethereum.
Operating outside the traditional system.
Completely. They function beyond the direct reach of traditional capital controls. In a world where governments are trying to trap capital and erode fiat value, these could act as alternative stores of value. Potential lifeboats, as some people call them.
We saw Bitcoin rally during the banking stress in 2023, didn't we?
We did. It acted, for some investors, as a hedge against instability in the traditional system. So crypto presents both a potential tool for the system via stablecoins and a potential escape hatch from the system via decentralized assets. It's a totally new dynamic compared to the post-WWII era.
Okay, so if financial repression seems like the most probable path for governments, the path of least resistance, what other choices do they even have? And more importantly for our listeners, what can you actually do about it?
Well, governments technically do have alternatives to financial repression. They just tend to be politically much harder.
Like what?
There's serious fiscal consolidation, austerity, deep spending cuts, significant tax hikes, very unpopular.
Right.
Then there's debt restructuring or even outright default. That's the nuclear option. It can trigger massive financial crises, destroy a country's creditworthiness for years. Very high cost.
What about just growing the economy faster?
Economic liberalization, pro-growth reforms that could certainly help shrink the debt relative to GDP. But those often involve difficult structural changes, and the political appetite might not be there, especially in the current climate.
And getting all countries to coordinate.
International coordination on debt or fiscal policy. Highly unlikely given current geopolitical tensions. Everyone's looking out for themselves.
So when you line up all those difficult options,
Financial repression looks like the easiest path for politicians. It avoids immediate sharp pain. It hides the costs. It's politically survivable, even if it slowly erodes wealth over the long term.
okay, so understanding that landscape, what does Napier suggest for individual strategy? He doesn't foresee a sudden crash like '08, right? He talks about a different market sequence.
That's right. He predicts something more like an initial market melt-up, potentially, followed by a slow, grinding decline.
A melt up first. Why?
In the early stages, you've got lots of liquidity sloshing around, maybe negative real interest rates. Investors are desperate to find any return, anything to beat inflation. So money pours into assets, stocks, property, maybe crypto, pushing prices higher.
Sounds good initially.
It can feel good. Every dip gets bought, momentum seems unstoppable. But Napier warns this is built on shaky foundations.
And then comes the grind down.
Eventually, yes. As the regulatory screws tighten, as institutions are forced to allocate more to government bonds, they have to sell other things. Equities, corporate bonds.
So it's not a sudden panic sell-off.
Not necessarily. He describes it more like a changing tide. Think of it this way. It's not a sudden meteor strike like a crash. It's more like the tide shifting. First, there's that rush forward, the melt-up. But then the underlying current changes direction, slowly but surely pulling capital away from private assets and towards government bonds. A long, drawn-out process engineered by regulation.
A slow siphoning of capital.
Exactly, which makes just sitting passively in broad market indexes potentially quite dangerous over the long haul.
Okay, so what's the actionable advice then? For traditional investors first.
The big lesson is, don't underestimate inflation's corrosive power. Holding cash or bonds yielding less than inflation is a guaranteed loss in real terms.
So move away from cash and traditional bonds.
Generally, yes, or at least be very underweight. Consider shifting towards those hard assets we talked about, gold, commodities, maybe real estate. And look at specific equity sectors like value stocks or those aligned with government spending like infrastructure. Less focus on passive index tracking.
And diversification.
Absolutely critical. Diversify across geographies and asset classes. Don't have all your eggs in one basket, especially not one controlled by a single government increasingly resorting to repressive policies.
Okay, and what about for crypto investors? Similar themes or a different playbook?
Similar themes about inflation protection, but with unique twists. Financial repression could drive more speculative flows into crypto as people seek alternatives, so you might see big rallies.
But also risks, right? You mentioned regulation.
Huge risks. As governments try to maintain control and trap capital, expect more attempts to regulate, monitor, maybe restrict crypto, especially on-ramps, off-ramps, and stablecoins.
So what's the takeaway?
Prioritize self-custody if you're holding decentralized assets. Understand the regulatory risks are real and likely growing. Stay agile. Be prepared for volatility, both sharp upsides and potential crackdowns.
So for everyone, traditional or crypto, the main message seems to be, don't just assume the old rules apply.
That's the core message from Napier, I think.
Hmm.
Don't trust that what worked for the last 10 or 20 years will work for the next 10 or 20. Financial repression is a fundamental regime change, even if it happens slowly.
So being passive is dangerous.
Being passive is probably the greatest risk of all in this environment. You need to be proactive. You need to understand inflation, diversify wisely, consider hard assets, and be aware of how both traditional finance and newer systems like crypto fit into this changing landscape.
Being proactive isn't just a good idea, it's essential.
It's essential for preserving wealth.
You know, all this raises a really important question, I think. If these kinds of stealth taxes, like financial repression, are becoming the new normal, how deeply do we actually need to rethink our basic financial habits and assumptions to achieve any kind of real long-term security? Something to definitely mull over.
Food for thought.
Well, that's all the time we have for this deep dive. Hope you found it helpful. If you did, please do follow, like, and maybe share this deep dive with others who might find it useful.
Yeah, spread the word.
And of course, don't forget to follow What Bitcoin Taught Me pretty much everywhere. Twitter X, Nostra, Bluesky, Threads, Instagram, Facebook, and LinkedIn. We'll catch you on the next one.